Assalamu alaikum, I'm Bilal and I work on the team here at Wahed Real Estate. We review property deals every single day, analysing the numbers, running due diligence, speaking to experts and working to make sure that the investments we offer meet the standards our investors expect. Now, if you've ever looked at a real estate opportunity from us and felt lost in the numbers, yield percentages, ROI calculations, costs and fees, is completely normal. We hear that a lot and that's why we made this video. I'm going to walk you through the key real estate investment metrics that you see in most of our deal documents and explain what they actually mean. Just a heads up, it's a long list. But by the end, trust me, all of these confusing terms will start to make sense and you'll be able to look at real estate investment opportunities with a lot more confidence. So let's get into it. When you're reviewing a property deal, one of the first things to ask is, am I getting good value for money? That's where these three valuation metrics that I'm going to talk about come in. The first one is purchase price versus market value. This tells you whether you're buying at, below, or above what the property is actually worth. For example, if a property's market value is £420,000, but the price you're paying is £400,000, you're buying it below the market value. The second thing that you look at is price per square foot. This helps us compare properties of different sizes and different final prices. So all you've got to do is just divide the purchase price by the property's total area. For example, if a property costs £400,000 and has 1,200 square feet in it, then that's around £330 per square foot. Now, if you compare that to similar properties in the area and they average at 350 or 380 pounds per square foot, then you're getting value because it's less than that. But if the other ones are selling for £200 per square foot, then you might be overpaying. The third thing we look at is discount to market. Now, this metric is a percentage that shows you how much below market value you're acquiring the property. So going back to our earlier example where we bought a property for £400,000 and the market value in that case was 420, well, obviously the difference between the two is 20,000. So we have a £20,000 discount. Comparing that to the market value of 420,000, we have a 4.8% discount to market value rate. Remember, all of these valuation metrics are your first line of defense against overpaying. And if you can master those, you're already ahead of a lot of investors when it comes to property. After you know you're not overpaying for something, you want to look at the rental yields. And we talk a lot about that in our investment opportunities too. So the first thing you've got to understand is the difference between gross yield and net yield. When investing in property, understanding the income potential is crucial, and that's where the difference between those two comes in. So number one, gross yield. This is the headline number you'll see often in many listings on property investments. It represents your rental income before any expenses are deducted and is calculated as an annual rental income divided by your total investment. So for example, the expected annual rent for a property might be £30,000 in that year. And the total investment to buy the property was £400,000. So your gross yield would be 7.5%. Attractive, right? But now let's look at net yield. This is what actually goes into your pocket after costs like property management fees, maintenance fees, and service charges. It's calculated as your total rental income minus your operating expenses divided by the total investment of how much it costs you to buy the property. So for example, after expenses, your original £30,000 of income may have gone down to £20,000 of income. And so if you divide that by your original investment, that's around a 5% net yield instead. And the 5% number is what you should focus on. Another thing to look at, especially with multi-year investments, is average net yield. And so this represents the expected average annual net yield across the entire holding period of the property. It accounts for projected rental increases, as well as one-off or projected increased maintenance costs as well. So for example, let's say your net yield from the past one was 5.5% in year one, but it might grow to 6% by the 5th year of you holding that property. So your average net yield is 5.75. Understanding these yield metrics gives you more clarity on the actual income your investment might generate, and it will help you inform any decisions you make on whether or not it's a good deal for you when it comes to how much you're investing and how much you're going to earn in the end of it. A third thing to talk about is total returns and getting the complete picture of what your investment is going to generate for you in terms of returns. So most investors focus a lot on the monthly income, like the passive income when it comes to rent, but that misses the bigger picture. It misses the fact that when you eventually sell the property at the end of your holding period, it could be worth more than what you originally invested with and therefore appreciate, and you can then get that appreciation as additional returns. So along with collecting rental income, you can think about how much it might appreciate over time. So let's get into the metrics related to that. So first of all, you've got total net return. This is your overall expected return from both rental and capital appreciation after deducting all costs and fees. The second thing is annualized net ROI. ROI stands for return on investment. This is perhaps the most important metric for comparing different investment opportunities. It represents the expected average annual return on your investment after all costs and fees. For example, an annualized net ROI of 8.5% means your investment is projected to grow by an average of 8.5% each year over the holding period. This metric allows you to compare different investments and different holding periods. So, for example, a 3-year investment with 7% annualized ROI versus a 5-year investment with 10% annualized ROI. You can now compare apple to apple, even though they're two different deals, two different sizes, and two different properties at the end of the day. Another metric you might read about is called capital appreciation factor. Now, this shows you how much the property's value could grow relative to its original price. It's a projection. So for example, a factor of 1.2 suggests the property may increase in value by 20% over the investment period. Understanding those metrics helps you see beyond just the monthly rental income and evaluate the complete potential of your property. So it's both rental income that you're going to get every year, as well as the total appreciation of your capital over the entire holding period. At Wahed, our team carefully analyzes all of those metrics before bringing any opportunity to our platform, but understanding them yourself helps you select the properties that best match your investment goals. So, now that you understand these key metrics, you're in a much better position and better equipped to evaluate any real estate opportunity that comes your way, whether it's through our platform or anywhere else. If you have any questions, reach out to our team. It's support.ventures@wahed.com, and we're always here to help. Thank you for watching, and until next time, Assalamu alaikum.